Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at the UX sector.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, let's just jump straight in because the place to start here has to be the massive market opportunity. I mean, the numbers are the whole foundation for this thesis.
They really are. And when you look at the global market for UX services, the growth curve isn't, it's not gradual. It's almost vertical.
It's a surge.
It is an absolute surge. I mean, the data projects the global market will just rocket from about $6.4 billion in 2025.
Okay, $6.4 billion.
To potentially over $54 billion by 2032.
Wow.
Think about that for a second. That's nearly ninefold growth in, less than 8 years?
A trajectory like that just doesn't happen unless something fundamental, something structural is changing across entire industries. And we can already see that acceleration happening right here in North America, which is always a good...
It's a great proxy, yeah, a leading indicator for these global trends.
And that market alone, it grew from, $1.378 billion just a few years ago in 2021 up to $2.5 billion this year. The momentum is just undeniable.
And what's really encouraging here is that this isn't some flash in the pan. The long-term projections show an incredibly sustainable trend.
Right.
We're talking 11.824% compound annual growth rate, a CAGR, that's expected all the way out to 2033.
So this tells us companies aren't just, experimenting with design. They are embedding it into how they operate for good.
Permanently. So the question is why?
Yeah.
Why this sudden sustained explosion?
Yeah, user experience has always been important, but something clearly changed to turn it into a $54 billion opportunity.
It really boils down to two key drivers that are connected. First, AI integration. AI isn't replacing designers. It's just enabling firms to analyze user behavior with, unprecedented precision and speed. But the second, and I think far more powerful driver, is the sharp focus on ROI.
Return on investment.
Exactly.
That ROI metric feels like the real pivot here, especially for SaaS, e-commerce, and fintech. Companies are now treating UX as a hard financial lever.
And that brings us to that headline number that really jumps off the page. Every single dollar invested in user experience can yield up to a $100 return.
That's a 9,900% ROI. I mean, that number sounds like it's from a sales pitch.
It does.
But if it's real, it just completely changes the calculus for a CFO. If you have a proven return that high, the investment becomes mandatory no matter the economic climate.
It's the ultimate defense against budget cuts. But we need to focus on the mechanism. How does that 100-fold return actually become cold, hard cash flow for these companies?
We're talking free cash flow, FCF, right? The stuff that lets you do R&D or pay back shareholders.
It relies on measurable conversions. Take a sauce company, for example. We see proven metrics showing like a 15 to 25% boost in their crucial trial-to-paid conversion rates just from optimizing the user journey.
AMR for e-commerce.
In high-volume e-commerce, those lifts are usually in the 8 to 15% range. This is an immediate revenue boost that drops straight to the bottom line, bolstering their FCF.
So it's a powerful feedback loop. You spend more on UX, you make way more money, which then validates an even bigger UX budget.
And you see that confidence reflected in the budget projections. 42% of companies expect to increase their UX research budgets by more than 30% next year.
That forward signal is maybe the most critical piece of evidence. It shows businesses are accelerating this spend, not slowing down.
Right, and don't forget the margin expansion. AI analytics are making them more efficient, letting them measure the dollar impact of every single design tweak.
That clarity is huge. But let's, play devil's advocate for a second. If the ROI is really that high, what stops every marketing agency from just pivoting and commoditizing the service? What's the competitive moat here?
That's the essential question. The moat's not the design itself, the aesthetics. The real competitive advantage is the data-driven ROI measurement.
The measurement.
Yes, and the specialized tools they use to quantify it. It's moving beyond subjective usability into hard financial proof.
So the moat is built around the tools that prove the design works financially. And then they link that proof directly to the client's revenue teams.
Exactly. And this creates incredibly high switching costs. A client isn't just hiring a creative agency. They're embedding these analytical tools right into their growth squads.
And switching would mean losing all that institutional knowledge. A generalist agency just can't compete with that.
They can't. And we have concrete examples that really drive this point home. We're seeing specialized firms achieving like 18% fintech sign-up gains.
In really complex regulated spaces, too.
Yeah, or another one delivered 17% conversion boosts specifically for SaaS companies. But the IKEA example is maybe the best one.
Right, that one stood out. A massive, traditionally slower retailer.
IKEA getting a 25% gain in cart-to-purchase conversions isn't trivial. I mean, that could be billions in realized revenue from optimizing just one simple step. It proves the thesis isn't confined to Silicon Valley startups.
And this whole shift has created a brand new, essential role inside these companies. The growth designer.
That is absolutely critical. Growth designers are the ones tying usability directly to the most important financial metrics.
Things like customer acquisition, cost CAC, and lifetime value, or LTV.
Precisely. Design has officially moved out of the making things look pretty department and straight into the CFO's office.
If you can prove your design lowers the cost to get a customer, you're not a cost center anymore. You're a revenue driver.
And with the cost of digital marketing going through the roof, the growth designer is indispensable. Your CAC is up. The best solution isn't more ad spend, it's better UX to maximize the visitors you already paid for.
That makes perfect sense. Okay, let's pivot to the technicals. The fundamentals seem exceptionally strong, but what are the charts telling us about momentum and timing?
Well, analyst commentary is flagging some pretty constructive bullish structures in these UX stocks, especially in the ones tied to that AI UX integration we talked about.
What kind of patterns?
You're consistently seeing higher highs and higher lows. Sometimes these are even forming cup and handle patterns, which usually validate that strong future revenue growth that the CAGR is projecting.
And what about broader momentum signals?
If you zoom out, they're also constructive. We're seeing what some technicians call a golden cross proxy.
So that's the short-term 50-day moving average crossing above the long-term 200-day.
Exactly. In these high ROI firms, it's a classic signal that institutional money is moving in and accumulating positions. They're recognizing that AI-enhanced growth potential.
And this isn't just random noise on a chart. It's the market waking up to that accelerating expenditure.
And on top of that, the Relative Strength Index, or RSI, is suggesting some hidden bullish divergence. So even if the price looks a bit quiet, the underlying strength fueled by that expectation of huge budget increases is building up.
So for an investor looking at the sector now, where are the attractive entry points clustering? What levels are key?
The key support levels seem to be clustering pretty robustly around the recent lows we saw established in 2024.
So that suggests a solid floor.
A solid foundation, yeah. These points look like attractive entry opportunities, especially since that 11.8% CAGR really validates the long-term story here.
Okay, strong fundamentals, bullish technicals. Let's look ahead. What's on the catalyst calendar? What could drive the next leg up?
The immediate key focus has to be the Q1 2026 earnings reports. They'll be out in January and February next year.
And the expectation is they'll beat consensus.
Given the CAGR momentum and that shift to measurable AI ROI metrics, yes, they're widely expected to exceed current estimates.
And beyond the company reports, the macro environment is helping out too, right?
For sure. Prospective rate cuts always favor a rotation back into growth tech and services, which is a huge benefit for the UX space.
But the biggest macro factor has to be the rising cost of acquiring a customer. That CAC number.
It's the most important one. CAC has risen an astronomical 222% over the last decade.
Wow.
Which makes conversion optimization tools, the core product of these UX firms, absolutely non-discretionary. If it costs a fortune to get a lead, you have to maximize its value.
And UX is the highest ROI way to do that.
By far.
Okay, but we have to talk about the risks. What's the bear case here? What could slow this down?
It's a necessary discussion. There are two primary risks. First is potential transition pain. As companies pivot their internal teams to these AI-fluent growth designers, you could see some, friction or even temporary layoffs.
Internal disruption.
Right. And second is the more traditional threat of just a broad economic tightening. If the economy really seizes up, maybe some of that spend slows down.
But how strong are the counters to those risks? I mean, with a 9,900% ROI, should tightening even matter?
The counter-arguments are very robust. For the transition pain, the need for growth designers is so critical that the firms helping with that transition become indispensable.
And for the tightening?
The 100-fold return is the ultimate shield. Companies cut costs that don't generate cash. They double down on investments that return 100-fold. That 42% of companies planning to increase budgets by over 30%, that suggests the tightening effect is pretty negligible here.
And finally, what about the speculative chatter? There's always rumors in a hot sector.
Oh, always. There's persistent chatter around M&A, especially with smaller, specialized agencies getting acquired as the market scales toward that $54 billion number.
And new tools.
Yep, rumors about unannounced AI UX tools that are focused on radically reducing CAC even further, but it's really important to stress immediate market sentiment is neutral. We have no confirmed headlines on any of this.
So if we put all of this together for you, the core thesis is pretty clear. This isn't just a short-term trade based on hype.
No, it's a multi-year growth opportunity. It's fundamentally driven by AI and a competitive moat that's built on, well, quantifiable financial impact. Design has irreversibly moved from a subjective art to an objective revenue engine.
If this analysis helps you understand the massive transformation happening in the UX sector, please subscribe, like, and share Smart Wealth with Joshua to support our show.